Opendoor is having another rough session today, trading around $7.63, down roughly 6% midway through the trading day. And on the surface, this looks like the continuation of a slide that started several sessions ago. Remember, just last Wednesday the stock was trading up in the 950 range. It had momentum. It had energy. It had a breakout look to it. Then we've seen several sessions of selling as the broader market has rolled over and sentiment across tech and housing has weakened. But while the price action looks negative, the story underneath the chart is a lot more complicated, and depending on how this plays out over the next 24 to 48 hours, this pullback could still be part of a larger setup rather than a sign that the story has broken. Let's start with the obvious. This isn't just Opendoor falling in isolation. The whole market is under pressure. Indices are down. High beta names are bleeding. Housing names in particular have struggled as traders digest mixed signals on rates, consumer health, and growth. In that context, Opendoor giving back some of the gains from last week isn't surprising. What matters is whether this slide is simply a reflection of macro weakness or whether it signals a shift in the structural forces that have been driving the stock over the last few weeks. And right now, those forces are still intact. Because while everyone is watching the day-to-day candles, the bigger picture hasn't changed. The Warrant dividend record date is tomorrow. That is the moment that determines which shareholders receive the tradable Series K, Series A, and Series Z warrants. These are meaningful financial instruments with strike prices at $9, $13, and $17, and they create a pretty unusual set of incentives in the market. If you're long, you have a reason to hold through the record date. If you're short, you have a reason to reduce your exposure because you do not want to owe the economic equivalent of that dividend. This is not just some feel-good perk. It's a structural pressure event. And yet, despite that upcoming catalyst, the stock has slid from 950 down to the 760s. That's enough to make some investors ask whether the setup is failing. But it's also exactly the kind of move you sometimes see right before a major catalyst because the market wants to shake out weak hands, reduce leverage, and set a stable base. No stock runs in a straight line. And when you have this kind of imminent incentive structure, it's not shocking to see traders step back, rebalance, or even push the price lower temporarily to test support. The real question isn't why the stock has fallen. The real question is whether anything fundamental has changed. And the answer, so far, is no. The macro picture, the short interest, the warrant dividend structure, and the insider alignment are all still in place. The CEO, Nejatian, bought roughly $1 million worth of stock just days ago. That's not a move someone makes lightly. That's not a symbolic gesture. That's real conviction on display. And it's one of the reasons the long-term story still holds together even with the short-term slide. But let's talk about that slide. Because we can't just pretend the stock going from 950 to 760 is meaningless. It's meaningful. And the meaning comes from the psychology behind it. After a series of powerful green days, fueled partly by macro optimism, partly by the insider buy, and partly by the hype surrounding the warrant dividend, the stock was extended. It was due for a pullback. Combine that with a weak market and the fact that some traders always prefer to avoid holding through a catalyst with a lot of attention around it, and the selling pressure makes sense. The key here is that while the stock is sliding, it hasn't broken its broader structure yet. It hasn't collapsed. It's still above major support levels. It's still trading with healthy volume. And the selling we've seen hasn't been panic selling. It's been methodical, almost mechanical. That's what you expect to see when funds, algorithms, or short-term traders reposition ahead of a known event. If this were a true breakdown, the volume, the speed, and the tone of the move would be very different. Another important angle is the broader sentiment around short interest. A few days ago, the narrative was heating up around the possibility of a slow-burn short squeeze. Short interest is still elevated. Borrow costs are still high. And heading into the warrant record date, short sellers have extra risk. When a stock is approaching an event like this, you often see exaggerated moves to the downside as shorts attempt to push the price into a lower range before the dividend snapshot. The lower the stock is, the less valuable the warrants appear, and the less economic cost shorts could face. That doesn't mean manipulation. It means motivation. And markets move on motivation. So when you see a slide into a catalyst that theoretically benefits holders, you need to view the move through that lens. If the stock can find support around this $7.50 to $8 region and stabilize, the setup for Tuesday and Wednesday becomes even more interesting, because the structural pressure on shorts doesn't go away unless the price collapses past the point of concern, and so far that's not happening. But we need to address what this means for traders, for investors, and for anyone watching the story. What you have right now is a swing point. A spot where momentum has cooled, expectations have normalized, and the market is waiting to see what happens when the warrant dividend record date hits. If the stock holds support and finds buyers, the next leg of the story becomes a question of whether the pressure builds again. If the stock breaks down further, then sentiment will shift and the narrative will pivot away from the short squeeze ideas and back toward fundamental execution. For a video today, the best angle is to lean into that tension. The story is not that Opendoor has fallen. The story is that it has fallen into the single biggest structural catalyst of the quarter. The stock is sliding into the record date. It's not collapsing. It's not exploding. It's coiling. The question for viewers is simple. Is this weakness a reset, or is it a warning? And you can frame the argument that, given the insider activity, the macro tailwinds, the still elevated short interest, and the meaningful nature of the warrant dividend, this pullback still fits within the category of healthy consolidation, unless and until the stock loses major support. And don't forget the bigger picture. Eric Jackson's $82 thesis hasn't gone away. The long-term believers are still believers. The question now is whether this moment, right here, is a shakeout before the event, or the beginning of a deeper correction. And the truth is, at this mid-session point, both outcomes are possible, but the setup for the bullish case is still intact. The stock has room to recover. The catalyst is still ahead. And the structural story is still alive. This is the moment where conviction becomes visible.